Assalamu alaikum students. Hello, how are you dear students? Well, I am back again. You have watched my introductory lesson of ICOM first year part 1 principles of economics. And here again, in the name of Allah I begin, who is most merciful and beneficent. Today I am going to address or deliver the lesson 11.1. It's a continuity of the course pack developed by me for the ICOM students. Today's lesson is from your macroeconomics section of your book, and this section will include 5 chapters. Little introduction of the section. Chapter 11 Chapter 11 National Income. Chapter 12 Theory of Money. Chapter 13 Trade Cycle or Business Cycle. Chapter 14 International Trade, and Chapter 15 is the Public Finance. So, Chapter 11, little introduction of the Chapter 11. It is National Income, and this chapter will be covered in the 5 lessons, and watch from start to till end. If you attend all the 5 sessions, inshallah, you will be able to grab the all concepts of this particular chapter. And from board point of view, it is a very, very important chapter. I mentioned already in the course pack that national income covers 15 to 20% of the paper in almost every exam. Means 9 out of 10 times it covers 15 to 20% of the paper. So it's very important. And our today's agenda is the lesson 11.4. Lesson 11.1, different concepts of the national income. That is we are going to discuss in today's lecture. Chapter 11, National Income, lesson 11.1, different concepts of the national income. We will discuss following concepts in it: national income, gross national product, gross domestic product, net national product, and net domestic product, personal income, and disposable personal income, and in the last, the per capita income. So here we go. The concept number 1, that is called national income. I will define it in 2 perspectives, according to Marshall and according to Campbell. According to Marshall, the aggregate of all the final goods and services produced in a country during 1 year is called national income. So there are 3 important words to understand. Number 1 is the aggregate. It means you have to sum up what? All the final goods and services. What are final goods and services? Final goods and services are those which are used by the end user. For example, you purchase a mobile, you are the end user for the finally produced good and service, that is a mobile. For example, you purchase a bicycle, that is a final good and service produced. And third important point in this is that it should be produced in the current fiscal year. So all the goods and services, finally produced goods and services produced in 1 year, take the aggregate of those, and that will be your national income of the country of that year. Second definition is according to the Campbell, and Campbell says you have to take total market value of all final goods and services produced in a country during 1 year. It means that total market value, what does it mean? Market value is the value of a good that it is paid in the market. For example, you buy a mobile for 15,000 rupees, so it is the market value of that mobile. So you have to sum up the market value of all finally produced goods and services in a country during 1 year. 1 year is very important. Watch it. So here we go. The second concept is a gross national product, GNP, total market value of all goods and services produced by the people in or outside their country. We can understand the production inside. What does it mean by outside? It means few of the members of our nation have gone to different countries and they are working there and they are producing something. But in our country's GNP, that amount would be included which they sent back to our country. So income from abroad, that is called income from abroad. Whatever we earn by investing in other countries, it is the production outside the country for our country. So we have to take the total market value, the market value at the price at which they are sold, all finally produced goods and services by the people of our country inside or outside the country during 1 year is called GNP. So equation for the GNP to understand is GNP is equals to GDP, means whatever is produced within the boundaries of our country, plus the income from abroad, whatever is earned by our people outside the country, minus income of the foreigners taken away. Obviously, some people have come to our country and they are working here. They will also send them amount of money or income to their homes as well. So that will be excluded. So GNP is equals to GDP plus income from abroad that comes inside and the income of the foreigners taken away. For example, if the GDP is 200 rupees, income received from abroad, our people working abroad, they sent us 100 rupees. So it makes total of 300. But the income of the foreigners taken away is 50. So you have to deduct it from 300 and net, in the end, GNP is equals to rupees 250 for the Pakistan. I hope you understand that. Gross domestic product. Total market value of all final goods and services produced by the people within the geographical boundaries. Now, this is the point of difference. In GNP, it was within or outside, but in GDP, the only those things and goods and services are included which are produced in the geographical boundaries of the country in 1 year. Equation for the GDP is equals to simply deduct foreign income from GNP. GNP includes the foreign income as well, so deduct that. From GNP, you will get the GDP, the only within the country. And GNP, for example, we have produced computers produced worth rupees 250. Computers are a product and we have produced it worth 250. Income received from abroad is 100. So we have to deduct it to get the GDP equal to 150. And now net national product. Its name is very clear, net. And net is obtained when we deduct something. So if we deduct depreciation from GNP, within or outside the geographical boundaries. So we have to deduct depreciation from GNP. We will get NNP. NNP is equals to, the equation is very clear, NNP is equals to GNP minus depreciation of the capital goods. Example, if GNP is produced 250, depreciation allowance is 100, so we will deduct it and NNP will be there 150. So chapter number 11, national income, lesson 11.1 is continued, different concepts of national income. And now we are discussing the net domestic product. Again, it is very obvious from its name. Net will be obtained when we deduct depreciation from gross domestic product. GDP may say. From GDP we will deduct the depreciation. Again, equation is very clear. NDP is equals to GDP minus depreciation allowance. And in the example, you can understand GDP is equals to 250, depreciation allowance is 100. Your NDP, the remaining one, will be 150. So now national income at factor cost. What is factor cost? Factor cost is the expense that is incurred by the entrepreneur in purchasing different factors of production. Whatever the reward is paid to the factors of production in the form of rent, wages, interest, and profits, you need to sum up those rewards given to 4 factors of production. This is called national income at the factor cost. Functions of the national income. National income at factor cost is equals to rent plus wages plus interest plus profit. Example, if rent is equals to 100, wages is equals to 100, interest is 50, and the profits earned by the entrepreneur are 200. So summing up all these rewards to the factors of production, we will get 450 in total. This is our national income at factor cost. And now, personal income. Total income received by the individual of a country from all legal sources in 1 year. Very important. Individuals, legal sources, and 1 year. Personal income is equal to sum of the individual's income. Simple. This is the equation. And now, example, income of the doctors is equal to 250. For example, income of the teachers in the country is 100. So what is the personal income? Sum them up and it makes 150. And now, disposable personal income. If we deduct direct taxes from the total income received by the individuals of a country from all legal sources in 1 year. Now we have to deduct direct taxes from the total personal income. So equation is very clear. DPI is equals to sum of the individual's income, that is personal income, as we defined earlier, and you have to deduct the direct taxes from this personal income. Income of the doctors 250, income of the teachers 100. So total personal income is 350 and direct taxes are worth 50 rupees. So DPI, disposable personal income. Disposable means which we can use with our own will. So we can use after paying the tax to the government. So this is 300 left after deducting the direct taxes that is paid to the government. And per capita income now. Per capita income is the average income obtained by dividing total national income by total population. Total national income divided by total population. Students, you know the fact that all the residents of the country do not earn. Most of them are dependent in our system of economy, or most of the countries. Almost 1/4 of the people are working and earning. But to find the per capita income, you have to divide by whole population. Example, total national income is equals to rupees 1000, for example. Total population is 500. Per capita income will be 1000 divided by whole population. Again I repeat, whole population, not only the working lot. So 1000 divided by 500, it makes rupees 2 per capita income. So dear students, here was the lecture 11.1, different concepts of national income. Good luck and stay blessed. Further lectures will be uploaded soon, inshallah. Thank you very much.